Takaichi's challenge to the Bank of Japan, a political reality check. Japan's potential next prime minister, Sanae Takaichi, has questioned the independence of the Bank of Japan (BOJ), arguing that the central bank should coordinate more closely with government policy. Her remarks have reignited debate over how much control Tokyo should have over monetary policy and whether such interference could undermine investor confidence. Takaichi's stance reflects frustration with what she sees as the BOJ's overly cautious approach. She wants to keep monetary conditions loose to boost growth and counter deflationary pressures. But analysts warn that challenging the BOJ's independence will not be easy given the country's political structure and legal safeguards. The Bank of Japan Act of 1998 grants the central bank strong autonomy. While the government can appoint the governor and board members, those appointments need parliamentary approval. Direct dismissal of a governor is legally difficult, meaning Takaichi would have limited power to force changes quickly. Politically, Takaichi's Liberal Democratic Party (LDP) does not hold unshakable dominance, and she may need coalition partners to form a government. Many senior LDP figures, including former finance officials, favor a cautious monetary stance and may resist moves that risk instability. On the economic front, BOJ Governor Kazuo Ueda has started gradually tightening policy after years of ultra-loose stimulus. Takaichi, in contrast, prefers to maintain low interest rates to support domestic demand. However, if the yen weakens further or inflation accelerates, her policies could backfire, forcing the government to act to protect purchasing power and market credibility. Markets have already shown sensitivity to her comments. Investors fear that any clash between the government and the BOJ could trigger volatility and raise doubts about Japan's fiscal discipline. Financial analysts say the so-called Takaichi trade, optimism around growth-friendly policy, might lift bank and industrial stocks temporarily, but longer-term risks remain if inflation expectations rise. In essence, Takaichi faces a balancing act, boosting growth while maintaining the BOJ's credibility and market confidence. Too much political pressure on the central bank could weaken Japan's reputation for stability, a key asset in global markets. Her remarks signal a tougher tone toward the BOJ, but transforming rhetoric into real policy will be difficult. Legal, political, and economic constraints mean her room for maneuver is limited. Takaichi's challenge highlights a fundamental tension in Japanese policymaking: the government's desire for growth versus the central bank's duty to maintain stability. For now, her bold words may remain just that, a political message, not a policy revolution.